Welcome to FIG's weekly economic and trading update. I'm Mark Bayley and this is Jessica Rusit.
Last week, geopolitical tensions played out across the markets, and there was also the announcement from Theresa May calling that early UK election. What did you see in the economic data?
Yeah, so it was more about geopolitical concerns last week, and they've been continuing again overnight. We've seen the terror attack probably in Paris with the shooting of the policeman. But back to the UK, I mean, people say it was a surprise, but I guess I've been talking about it since November last year as a possibility. You look across the benches in the House of Parliament, you see a very weak Labour Party, almost unelectable under Jeremy Corbyn. And it's no surprise that she's decided to call a snap election to try and strengthen her hand in terms of the Brexit negotiations with the EU. In terms of impact on financial markets, we did see sterling strengthen quite considerably on the back of that announcement, and also a bit of a kind of a rally in gilts as well. That's kind of reversed slightly over the last couple of days as the markets have digested that. In terms of the key economic data out of the States, we saw a pretty weak CPI print out of the States, well below consensus. And that has had a fairly big impact in terms of what we're seeing in US Treasury yields. Over the last month, they've rallied around about 20 basis points in the 10 years and similar amounts across the curve as well. So there's been a fairly significant move, and that's also played out in Australia, where we've seen similar moves in the curve, a lot lower as markets and bonds have rallied. So there's been pretty significant moves. There's been a bit of a risk-off trade as those geopolitical concerns continue. Obviously North Korea and the US situation there and the tension there. So investors are taking a bit of profit out of equities and putting those into safe haven assets of government bonds. So Jess, in terms of the risk-off trade that we've been seeing more broadly globally, have FIG's clients been doing a similar type of transaction?
Yeah, we are actually seeing that come through, where they are comfortable with the credits in their portfolios, but they are certainly looking at the exposure and moving into maybe higher rated paper. One in particular is the residential backed mortgage security bonds that we traded last week. It was Resimac 2016, the 2C tranche. Resimac is a non-bank lender. And so this is a floating rate note bond, so it's a good positioning for clients that do believe that this yield curve steepening will be coming through, and it's also a high rated bond as well, so that also is a really good positioning as well. We also had last week Access Today come to market and launch a fixed rate bond. This is a FIG originated bond. This is a callable from 2018, and it's got a 2021 maturity. Clients of ours will be familiar with Access Today. They came to market in 2015 with a floating rate note bond. So this is a this is a short dated bond, and it's also has the high yield component to it as well. So this was ideal for clients that were chasing yield but also wanted to shorten that duration as well, and move into the shorter end of the curve with any possible steepening we may see coming through.
And I think that's certainly what we've been telling clients to get their extra additional income coming through from going down the credit spectrum and shortening the duration. And that's certainly the case. And in terms of the RMBS, again, there's incredible value in my view in that investment grade rated space. The shorter dated, again, whiles our average life is very short as well, 2-3 years, and you get a better kind of yield in terms of any credit rating that you want to compare that to in the corporate space. So again, I think that's a certain sector that investors should be looking at heavily to diversify their portfolios and also get additional yield.
Yeah, that's right. And there was also a bit of activity in the US denominated space as well. We had some buybacks announced from Barminco and Broad Spectrum as well, which we have holders of those. And so Barminco has called its 2018 maturity bond, and that's using the proceeds from a recently issued 2022 maturity bond, and then Broad Spectrum called their 2020 bond. So we have institutional bids for both of these bonds, and so this allows investors to sell their positions now and reinvest those funds.
So again, it's kind of good news from investors getting the cash back, which is always good to get your principal back from the company, but again, it kind of leads to that refinancing risk and that refinancing problem, and where do I invest that cash going forward?
Yeah, that's right. And we have, we're coming across looking for new direct bonds to have really good investment opportunities to present to clients there. Next week, all eyes will be on the domestic CPI release. What figures are we expecting to come through with?
Yeah, so the headline figures is consensus is at the moment 0.6%. For the kind of the core or the RBA's preferred measures, we're looking at both the 0.5 for the trimmed mean and weighted median in terms of those figures there. Apart from that, it's a pretty light week in terms of data in Australia. Offshore, I think most people will be looking for next Friday's release of the US GDP figure, which is expected to come in Q1 at 1.2%, so considerably lower than the 2.1% recorded for fiscal year 16. But again, there's been quite a big divergence there in terms of what is actually expected. So I think most eyes will be on that, and that will kind of give a bit of guidance as well for underlying US Treasury yields for the next month or so. Thanks, Jess.
Thanks, Mark.
Thanks for watching. Tin hats on, enjoy. If you need any more information, please go to The Wire.